Here is something you almost never see. 12 of the well-known investors whose filings we follow hold this company, and last quarter they went in opposite directions. 8 of them bought more, 4 of them cut. Same business, same filings, completely different conclusions. The company is Thermo Fisher Scientific. If you have never heard of it, that is normal, because it does not sell anything to you. It sells the instruments and supplies that laboratories run on. Microscopes, reagents, the machinery of research. When a drug company or a university runs an experiment, a lot of what sits on that bench came from here. The quarter summary says it plainly: 12 holders, 8 new positions or additions, 4 trims or exits. That split is the interesting part, because these are not careless people on either side. At the top, Train of Lindsell Train has nearly 10% of his portfolio here, and he trimmed it. Underneath, Andreas Halvorsen of Viking added, Harry Byrne opened a brand new position, Benjamin Allen added, Dodge and Cox added, and Thomas Gayner of Markel added. Heather Brilliant trimmed. The people buying and the people selling are equally serious. So what is the actual disagreement? It comes down to one question about this business, and you can see the whole thing in a single chart of its profit margins. During the pandemic, the world needed testing, and Thermo Fisher made a great deal of what testing requires. Operating margin, which is what is left from each dollar of sales after running the business, climbed to 26.3% in 2021. That was roughly 10 points better than anything it had managed before. Then that demand disappeared, as everybody knew it eventually would. Margins have been drifting back down ever since. Last year, operating margin was 18.2%, and gross margin was 37.7%, which is actually below where it sat a decade ago. Revenue has been roughly flat since 2022. And there is the disagreement. One camp looks at that and sees a great business finishing a return to normal after an unusual boom, which is a fine time to own it. The other camp looks at the same lines and sees margins that are still going the wrong way, with no sign yet of where they stop. Both are reasonable readings of the identical chart. Our valuation read is not on the bargain side either. It says premium, meaning it costs more than this company has usually cost, and the price sits about 15% above its own 200-day average. At the close on the 19th of August, it was $613, up 4% on the day. Although one number does argue for the buyers. It trades at 32 times the earnings it actually made, but only 23 times what analysts expect it to make. That gap means the market is betting profits recover from here. If they do, today's price looks a lot more reasonable in hindsight. What I like about this one is how honest it is. There is no crowd to follow here. 12 people who are very good at this looked at the same company and split 8 to 4. That is what most real investment decisions actually look like, and seeing it laid out is far more useful than a story where everybody agrees. So if you were looking at this, your question is simple to state and genuinely hard to answer. Do you think those margins have found their floor? The buyers think so. The sellers are not convinced yet. You now know exactly what you would be deciding, which is the part most people never get to. Visit us at smartcharts.co, where we explain the stock market in plain English for people who were never given the manual. Nothing here is financial advice.